Hi looters, welcome back to Tick to Loot market updates for July 29th, 2026. We've got a fast-paced rundown of yesterday's data, today's calendar, and the big headlines shaping the FX arena. First, a quick reminder. This video is for educational purposes only and is not financial advice. Markets carry risk. Always do your own research and consult a licensed financial advisor before making any trading decisions. Let's dive in. Starting with yesterday, the market saw a series of low-impact releases. Japan's core CPI held steady at the forecasted 1.4% year-over-year, matching the previous reading, so inflation pressures remained unchanged. In Europe, Spain's unemployment slipped to 10.1% from 10.8%, a modest improvement but still well above the Eurozone average, keeping the euro relatively steady. Germany's BUBA report and the U.S. ADP employment numbers both came in as expected, with the goods trade balance narrowing slightly to a deficit of about $100 billion. Because none of these figures deviated from forecasts, they didn't spark notable moves in the major pairs. Turning to the headlines, Australia's June CPI surprised on the downside, coming in at 3.8% year-over-year versus the 4% consensus. The month-over-month figure also missed, posting a minus 0.1% change against the expected plus 0.2%. The trim mean inflation metric eased to 3.6% from 3.7%, reinforcing the narrative of cooling price pressures. For traders, lower than expected inflation often eases expectations for tighter monetary policy, which can soften the Australian dollar and reduce risk-off sentiment across the broader market. In the United Kingdom, the flash services PMI jumped to 51.8, beating the 49.4 forecast and up from 48.8 in the prior month. A reading above 50 signals expansion, and the surprise strength suggests the services sector is gaining momentum despite broader economic headwinds. While the manufacturing PMI stayed solid at 52.8, the services boost could keep the pound resilient, especially as investors weigh the implications for future monetary policy decisions by the Bank of England. Across the Eurozone, business activity finally turned positive for the first time in 4 months. The flash composite PMI climbed to 51.9, well above the 50.3 expectation, driven by a services PMI of 51.6 and a manufacturing PMI of 52.0. This rebound hints at improving demand conditions and could soften the euro's recent weakness, especially as investors reassess the European Central Bank's stance on rate hikes in light of softer inflation data. Germany's flash manufacturing PMI posted a robust 52.2, far exceeding the 50.5 forecast and up from 50.3 previously. The data points to solid order books and capacity utilization, reinforcing the view that Germany's export-driven engine remains resilient. For the euro, strong German manufacturing can act as a supportive factor, especially when juxtaposed with the broader Eurozone's tentative recovery. Looking ahead to today's calendar, Germany will release its import prices month over month. The forecast expects a decline of 0.7% after a 0.7% rise in the prior month. Import price movements can signal shifts in global commodity costs and exchange rate pressures, so traders often keep an eye on this low-impact release for clues about inflationary trends feeding into the euro. Switzerland's UBS Economic Expectations Report is also on the docket. While the impact rating is low, the survey gauges business confidence and outlook for the Swiss economy. A shift in expectations can subtly influence the Swiss franc, especially in a risk-off environment where safe haven flows tend to favor the franc. The UK will publish its M4 money supply data for the month, with a forecasted increase of 0.2% after a 0.1% rise previously. Money supply growth can affect liquidity conditions and, indirectly, the pound strength. Although the market rates this as low impact, any deviation from expectations could prompt a brief reaction in short-term GBP pricing. Next up, UK mortgage approvals are expected to hit 57,000, a modest uptick from 56,000 in the prior month. Mortgage activity is a proxy for housing market health and consumer confidence. While the figure is modest, it can provide insight into the demand side of the property market, which in turn can influence the pound's trajectory if the data signals a broader economic shift. Finally, the UK's net lending to individuals is slated to rise to £5.5 billion, up from £4.6 billion in the previous month. This metric reflects how much credit banks are extending to households. An increase suggests easing credit conditions, which can support consumer spending and potentially buoy the pound, especially if the data outperforms the modest forecast. That wraps up today's market snapshot. Looters. We saw lower than expected Australian inflation, a surprisingly strong UK services sector, and a revival in Eurozone business activity, all while today's calendar offers a suite of low-impact releases that could still add nuance to price action. Remember, this analysis is educational only. No trading recommendations here. If you found this useful, hit subscribe and ring the bell so you don't miss tomorrow's update. Until next time, keep your eyes on the charts and trade responsibly.